Hi everyone, this is Manideepak from Momentum Lab. Today, I wanted to dive deep into the mid-cap funds that we have in India, mid-cap mutual funds. And so I start with defining what are mid-cap funds, how does SEBI or AMFI define this, talk about the benchmarks that they evaluate themselves against, and get into the performance of each of these funds in the last few years. Before I begin, I just wanted to mention that this is in no way recommending any funds to you, but this is just to educate you on what kind of metrics that you can look at. Again, we are looking at a specific set of metrics. There's a lot of metrics that you can look at. There's a lot of analysis that you can do before you actually start putting your own money into it. So I would highly recommend you to look at any fund that you want to invest in very comprehensively. Look at from multiple angles, drawdowns, returns, risk. Don't look at point-to-point comparisons. Look at rolling returns, rolling volatility. So that kind of gives you an idea of how the fund has performed across different time periods, across different market regimes, and that kind of gives you an idea of how the fund is actually performing during these different market conditions. And that gives you confidence on whether you want to bet against it or not. So before delaying any further, I want to quickly jump into the definition of a mid-cap fund. So this is the AMFI website. As you can see, a mid-cap fund is where at least 65% of the investment goes into the mid-cap stocks. So let me define what mid-cap stocks are. So this is a circular from SEBI on the definition of mid-cap funds. It starts from 101 to 250th company in terms of full market capitalization. So essentially, if you rank the companies by market capitalization, these companies stand between 101 to 250. Now, let me talk about the allocation further. Here, as you can see, 65% of at least 65% of the allocation should go into mid-cap companies. A maximum of 35% of the investment can go into other equity and equity-related instruments. So it could be large cap, it could be small cap, so any kind of companies, but equity-related up to 35%. But the minimum could be 0%. So the fund could very well invest all of the investments into the mid-cap companies as per this definition. And if depending on the market conditions, the fund manager can choose to invest up to 35% of the investments into debt and money market instruments. And lastly, up to 10% of the investments could be put into REITs or InvITs. Now let's look at the benchmarks that these funds usually evaluate themselves against. So if you see, this is the Kotak Mutual Fund website. So their tier 1 benchmark is Nifty Midcap 150. TRI is total returns index. So essentially including the dividends as well. And the tier 2 benchmark here, they consider Nifty Midcap 100 TRI. So this is how Kotak is evaluating their fund. Let me also show you how Axis is looking at it. So they are comparing themselves against the BSE Midcap 150, and the additional benchmark or the tier 2 benchmark here is Nifty 50. So while we measure the performance of a fund, we will look at both the 150, the Nifty Midcap 150 and also the Nifty 50 to see how the fund is performing in the next part of this video. Here are the list of midcap funds that we have. I've plotted them on a risk and reward space. So I have 3-year rolling returns on the y-axis and volatility or risk on the x-axis. So 3-year rolling return, I think we've defined this multiple times, is definitely a better metric to look at. So I put that on the y-axis, volatility, which helps us understand the fluctuations in the returns from a fund is on the x-axis. And the size of the bubble is essentially the max drawdown of any fund. So these two are the benchmarks that we just spoke about, the Nifty Midcap 150 and the Nifty 50. And here are all the midcap funds based on the 3-year rolling returns. Now, there are 4 funds here which do not have a lot of data. We're talking about, I think, roughly 7 to 7.5 years of data. So I don't want to put them in the same measure as others because these funds have at least 10 years of data. So I will just drop them from this graph. And now I think it makes a fair comparison. By the way, we're just looking at 10 years of data. That's the amount of data that I have. So with that 10 years of data, we're comparing these midcap funds with the benchmark indices. So as you can see, any investor would want their funds to be on the top left corner. So these are the set of funds that we need to focus on further. So that's exactly what I will try to do. So I'll pick Kotak Midcap Fund to begin with and see how is it faring against the benchmark, both Midcap 150 and Nifty 50. So here are the same list of funds in a tabular format. As you can see, we've put 3-year rolling returns, 5-year rolling returns, 7-year rolling returns, the max drawdown and the max drawdown days, along with annual volatility and the Sharpe ratio. So I've sorted these funds based on Sharpe ratio. Here, I define this ratio just purely based on 3-year rolling return upon the annual volatility. So you can see Kotak, HDFC, and Axis Midcap funds are in the top three. We'll start with Kotak Midcap Fund. We'll compare that with the index and see how that is performing in the last 10 years in different market conditions. Here in the screen, I will be comparing the Kotak Midcap Fund with the Nifty Midcap 150, which they consider as the benchmark. I'll just enter the weight as 1 and 1 and run the backtest. So we can now see all the different set of metrics for Kotak Midcap Fund versus the Midcap 150 benchmark. The blue line here is the fund itself, and the red line here indicates the Nifty Midcap 150 benchmark. As you can see, there were occasions where the fund is doing better than the benchmark. There were occasions there is the index or the benchmark that is doing better. So here in this case, during this period, you can see the red line is slightly above the blue line. That means the Midcap 150 benchmark is doing better. Then during the COVID times, I think the fund is able to recover well. You can see the drawdowns are lesser compared to the benchmark, and thereafter I think it's almost hugging the benchmark during these drawdowns. It's not better, much better, but it's almost on par with the benchmark. Now let me compare the monthly returns. If you look at Jan 2025, the fund did minus 8.5% versus minus 6.1% from the benchmark. So the fund did worse than the benchmark. And again, in Feb as well, minus 11% versus minus 10%. But when you see, when it recovered in March, it recovered better, right? So it did a 8.7% over the benchmark, which did about 7.7%. So you can see it's doing well on occasions and not doing well in few occasions. That's when we look at the rolling returns and we'll see how things perform there. So let's look at Sharpe ratio. So Sharpe ratio, you can see that the blue line has surpassed the red line during this period. Thereafter, I think you'll see the fund is doing as good as the benchmark. Here are some of the risk metrics. The max drawdown is minus 35% versus minus 43% from the index. The drawdown days is 734 days versus 1,046 days from the benchmark. Let's look at the rolling returns. These are the 3-year rolling returns. The median 3-year rolling return is about 23.5%. So if you're lucky, the 3-year max of 50% is what you get. 3-year minimum, if you're unlucky, is about minus 4.1%. This is slightly better than the benchmark, which did about 21%, which is the 3-year median for the benchmark. A max of 42% and a 3-year minimum of minus 7%. So let's look at the rolling returns on a timeline. So if you see the timeline here, initially it was doing well. Thereafter, it's almost very close to the benchmark in terms of 3-year rolling returns. As a result, you can see that it is saying that while the difference is statistically significant, the magnitude of difference between the mid-cap fund and the benchmark is small. So let's look at the 5-year rolling return. It is still small when we look at it from the magnitude standpoint. But when you look at the 7-year rolling return, it has improved slightly. So the magnitude of difference has become medium. So what that essentially means is that the longer you stay, the better it is. So when you stay longer in Kotak Midcap Fund, you will see that the difference between the fund and the benchmark becomes significant. Now let's compare the Nifty 50 benchmark. I think in their website as well, they mentioned that Nifty 50 is an additional benchmark that they consider. So let's compare and see how that looks like. So in terms of drawdowns, it's huge difference. Initially, the index did much better. Even during the COVID times, I see the benchmark here, the additional benchmark did perform much better than the fund itself. Now let's look at the returns. Here you see minus 8.5% in Jan 2025 versus minus 0.4% from Nifty 50. So the drawdowns you saw earlier, you're still seeing that in the recent time periods. The benchmark is doing better. But there are, of course, these patches of outperformance from the fund compared to the benchmark. So you see March 2025, it did about 8.7% compared to 6.3% from Nifty 50. So let's look at 3-year rolling returns. Let's see if the difference between the benchmark and the fund is significant or not. So if you look at 3-year rolling returns, it says the difference is significant, as you can see here, right? So the fund is doing much better than the benchmark. And if you look at 5-year rolling returns, the magnitude is still large. And when we look at 7-year rolling returns, the magnitude is still large. So if I can just summarize it in one line, if you're okay to bear the fund from a drawdown standpoint, this fund seems to be doing better than the benchmark Nifty 50. Now let's compare another fund, see how that is faring against Nifty 50 as a benchmark. We'll just run the backtest. So HDFC Midcap Fund is still doing better than the benchmark. Probably not from the drawdown standpoint. As you can see, the blue line is under the red line, which is the benchmark. And thereafter, I think they are very close to each other. I'll just quickly look at the monthly returns. You see the spurts of underperformance here, minus 6.6%, minus 8.5%. Though it recovered after, I don't think the magnitude of difference is huge, 6.8% and 6.3%. So here, if you see, it did 2.5% and Nifty 50 did 3.5%. And if we look at the 3-year rolling return and their difference, I think that's when we'll come to know. So if you look at 3-year rolling return, the magnitude of difference is large. The 5-year rolling returns, the magnitude is still large. And the 7-year rolling return, the magnitude is still large. So again, the summary is that it's highly volatile. But those people who have that risk appetite, I think this fund did better in terms of the returns. Now let's look at one of the funds. I'll take Aditya Birla Sun Midcap Fund. Here, if you see, the drawdowns are huge compared to the benchmark. I think HDFC Midcap Fund was also yielding the same kind of drawdowns compared to the benchmark. We'll also look at the monthly returns quickly. So if you see minus 6.6% versus minus 0.4%, minus 8.7% versus minus 5.8% in the recent years. And if we move to the rolling returns, you can see the magnitude of difference is small. So this is because there were times the 3-year rolling return of the benchmark is is better than the 3-year rolling return of this fund. So you can see the red lines are passing the blue line, and again the blue line now again surpassing the red line. So it's a bet in itself. You need to time this really well. Based on this graph, it looks to me like there could be chances that again this blue line could go below the red line given the cyclicality that we are noticing here. If I look at the 5-year rolling return, I see the difference is still small. And if I look at 7-year rolling return, I see the magnitude of outperformance from the fund versus the benchmark is still small. So if you're investing in any of these funds, make sure you're looking at these metrics, make a wise decision on how the fund is performing on a consistent basis. Make sure that this outperformance is not just based on the recent 1-year, 3-year, 5-year returns, but on a rolling basis. Take a longer history and see how this fund has performed, and not necessarily dependent on the fund manager, but it's just consistently beating the benchmark on a longer horizon. So if you are making sure that you're ticking these boxes, then you have a better chance of making better returns compared to the benchmark. So that's it from my end. Thank you, everyone.